There are three ways the examiner can test question here. You may be required to carry out financial performance evaluation. You are given a company financial statement, and you are required to evaluate that company's performance. You can compare that company with similar company. You can compare that company with similar company. That is what we call peer analysis. For example, you have to evaluate the performance of Dangote Cement. You can compare the performance of Dangote Cement with other cement companies. That is what we call peer analysis. Alternatively, you can compare the company with industry standard. That is what we call comparison with industry average. You are required to evaluate the performance of Dangote Cement in comparison with the industry standard. That is this cement industry. That is comparison with industry average. Or you can look at the performance of a company. The performance of a company for a number of years, over a period of time. You can compare Dangote performance between 2023 and 2022, 2020, 2021, 2020. You are doing trend analysis. That is performance. You may be required to carry out financial statement prediction. Recall, I mentioned that there are three ways examiner can test question here. There are three ways examiner can test question here. One, you are required to carry out financial performance evaluation. This evaluation can take the form of peer comparison. Please note this in your book. Please note this in your book. Get your book and note this. The financial performance evaluation can take the form of peer comparison. I'm giving company XYZ. I will now compare company XYZ with similar companies in the same industry, like say First Bank. I can assess the performance of First Bank in comparison with banks, similar banks, like Zenith, GT Bank, Access Bank. That is peer comparison. I can assess the performance of a company against the industry standard. Then I can do trend analysis. I will examine the performance of a company over a period of time, maybe 5 years. We also call it comparative financial analysis. You are comparing financial results for year 1 with financial results for year 2, with financial results for year 3. That is what we call comparative financial analysis. That is one set. Under this topic, the second way examiner can test question is to ask you to carry out financial statement forecasting. You are required to carry out financial statement forecasting. That is, you have to do a projection of the financial prospects of a company, the future financial prospects. For example, you are giving the financial statements for 2024. For example, you are giving a company financial statement for 2024. And you are required to predict, you are required to prepare financial statements, to forecast financial statements for 2025, 2026. That is projecting a company future financial prospects. That is the second scenario. The third scenario is you may be required to use financial statements to advise company on strategic decision making. You may be required to use financial statements to advise a company on strategic decision making. These are the three areas, or these are the three ways financial statements analysis question can be texted. Last week, the class was not that impressive. I must be very factual. At a point, nobody in class. We're looking at a question, but we couldn't attempt that question reasonably. Hopefully today, we'll be able to look at that question fully. So we are going to start that question afresh. Yeah, is the question. Please, it's advisable to have your copy printed. Once I'm done reading the question, we are going to move to Google to Zoom whiteboard, and we are going to start solution there. Illustration 3. Let's take the reading again. Choice Aluminium PSC is planning to raise 130 million new finance for a major expansion of its existing business. And is considering a rights issue, a placing, or an issue of bond. The corporate objective of Choice Aluminium, as stated in its annual report, are to maximize the wealth of its shareholder, and to achieve continuous growth in earnings per share. Recent financial information on Choice Aluminium is as follows. You are given financial information from 2014, 2015, 2016, 2017. Look at turnover. In 2014, you have earnings before interest and tax. You have profit after tax. You are giving dividends. You have share capital in Naira amount, 5.5 million. But please note, 1 Naira per share. You have your reserves, 8% bond. Your bond is debt. The share price given to us in Kobo. This is the current share price. The par value of the shares of Choice Aluminium is 1 Naira per share. That means if you have 1 Naira per share and you have 5.5 million, number of shares is also 5.5 million. The general level of inflation has averaged 4% per year in the period under consideration. That means inflation is the same every year. The bond of Choice Aluminium are currently trading at their par value, 100 Naira. Values for the business sector of Choice Aluminium, that means you are giving the industry average. For the business sector of Choice Aluminium, average return on capital employed, 12%. That is for this industry. The average return on capital employed is 12%. Average return on shareholders' funds, 20%. Average interest cover ratio, 20 times. Average debt to equity ratio, market value basis, 50%. Return predicted by the capital asset pricing model, 14%. The asterisk, look at the asterisk. Return on capital employed is calculated as earnings before interest and tax divided by the closing total capital employed. Requirements A. Look at requirement A. Evaluate the financial performance of Choice Aluminum. Comma. Analyze and discuss the extent to which the company has achieved its stated objective of maximizing the wealth of its shareholders and achieving continuous growth in earnings per share. The A part, the total mark allocated to the A part is 80 marks. Analysis 8 marks. Your evaluation 10 marks. Now, to the class generally, what are you expected to do with this question? You want to evaluate financial performance. You have like 3 things here to do. Evaluation of financial performance. Determine whether the company has maximized the wealth of the shareholders. Determine whether the continuous growth in earnings per share. You can now ask yourself, what are the ratios to be computed to carry out this evaluation? What are the ratios to be computed to carry out this evaluation? Yeah, the class is open. You must calculate some ratios here. What are the ratios you need to calculate? In this question, you can do 2 things. You can do trend. Compare 2014 with 2015, with 2016, with 2017. You are comparing performance of Choice Aluminum 2014 with 2015, 2015 with 2016, 2016 with 2017. That is trend analysis. You can also do industry comparison. You are giving the values for the business sector of Choice Aluminum. Look at the average return on capital employed. That means I can compute return on capital employed for Choice Aluminum. I will now compare it with the industry average. I can compute return on shareholders' funds for Choice Aluminum. I will now compare this with the industry average. I can compute interest cover for Choice Aluminum. I will now compare. I've tried to explain. So let us move to the whiteboard. Any question, please? Any question, please? All right.
So far.
Please get your question closer to you. Get your calculator closer to you. And get your writing materials. We move to the whiteboard. Okay. We need to prepare financial analysis. Okay. Financial analysis. You have your year. Twenty 2017. 2016. 2015. And 20. Now, let me ask the class. What are the ratios that you think is necessary to be computed here? If you are to evaluate this company financial performance. The line is open. Look at the turnover. From 2014, 2015, is it growing or declining? Or declining? Hello?
It's growing, sir.
Can we determine percentage growth in turnover?
Yes, sir.
Turnover growth in percentage. Let me take it to working 2 here. I'll come back here. Please check here. (2015) and 2014. What is turnover 2015? What is turnover?
19.1.
Minus turnover 2016.
16.8. 16.8. 8.
Divided by 16.8. What is the percentage growth? Multiply by 100. Yes, we did this last week, Sha. So some might be wondering, why are we going back?
14%. 14% approximately.
14%. Move to 2016 and 2015. Turnover 2016, how much, please? 24 million minus 2015, 19.1 million divided by 19.1 million multiplied by 100. What do you have, please? What's the growth?
26%.
26%. Check 27 and 2016. Turnover 28 minus 24 divided by 24 multiplied by 100. What do you have, please?
17.
17%. Then you can compute what we call geometric average growth. Geometric average growth. This simply means for turnover, 14 plus 26 plus 17 divided by 3. That is the geometric average growth. You should have 19%.
19.
Check it out. What you have done is called trend analysis. You have tried to trend this. So can I come here? In 2014, base year nothing, 14%, 26%, 17%. Average, our geometric average is 19%. You have trend turnover. What you have done, you have trend turnover. That, okay, this company is generating average of 19% growth in turnover every year. That is, your turnover is your revenue. If you want to measure company's performance, you need to look at that company's revenue. Your revenue is your strength. The income you generate is a major performance. This company is in business to maximize the wealth of the owner. To maximize the wealth of the owner, you must generate sufficient revenue. You must be able to grow revenue. Is that clear, please? Now look at earnings before interest and tax. Is it growing?
Yes, sir.
Can we compute the growth in earnings before interest and tax? Let's go back to working 2. You can come here. This is working 1. This is growth in turnover. Our working to growth in earnings before interest and tax. Do the same thing. Compare 2015 and 2014. Please, what is the earnings 2015 before interest and tax? Check.
6.8.
In 2015,
20,
2.5
2014. Yeah.
minus 2014, 6.8. There's growth now, Abby. Divided by 6.8.
Yes, sir.
Multiply by
That is
100.
10%.
What do you have?
10%.
10%. Is that Prosper?
Zainab.
Oh, Zainab. I was about asking after you. Wait, where's Amaka? She hardly missed class.
I'm here, sir.
Okay, let's allow Zainab to do the talking. Then go to compare. Amaka, you missed my class last week. 2016 and 2015. Earnings before interest and tax, 2016, how much?
8.5.
8.5 minus 2015 on how much?
7.5.
7.5 divided by 7.5, that is the base. Multiply by 100 over 1. What do you have, please?
13%.
13%. Check 2017 and
9.8.
9.8, are you sure? And 2016, okay, sorry, 9.8, yeah, you are correct. 9.8 minus 8.7, 8.5, 20, divided by 8.5. Multiply by 100 over 1. What do you have, please?
15%.
15%. Then look for the geometric average. I will shorten it, geometric average growth. This is equal to 10
30%.
plus 13 plus 50 divided by 3. What do you have?
13%.
13%. You can go back to sheet 1 now. Don't forget the figure. In 2014, 10%, is that not? 2016, how many percent? I think 13, Abby.
Yes, sir.
2017, how much? I'm not sure again. No, let me check. 10, 13, 15. The average. Geometry. Average. 15%.
15%. Oh, 13, sorry, 13, sir.
13, Abby?
It's 13%, sorry. Yes, sir.
Now, what you are saying is, where's our, pick our eraser. 13%. Now, what you are saying invariably is that this company operating profits, look at operating profits, is growing from 10% to 13 to 15. On average, the company's operating profit grows at an annual rate of 13%. Now, part of the question says we should compute, we should determine if the company has achieved continuous growth in earnings per share. Part of the question says we should determine if this company has continuous growth in earnings per share. That means you must compute earnings per share for you to be able to know if there's continuous growth in earnings per share. Is that not, please? Hello? Without calculating earnings per share, can you know if there's growth? Hello? I'm asking a question. Without calculating earnings per share, can you determine if there's growth in earnings per share?
I don't know.
I'm asking a question. Examiner says we should determine if this company has achieved continuous growth in earnings per share. I'm now asking the class, is it possible to determine growth in earnings per share without calculating the earnings per share? Is it possible? Yes, I'm asking the class, I'm asking a question. Hello?
Sir, I think it's possible, sir.
It's possible to know if there's growth in earnings per share without calculating it. How will you know? If you don't calculate earnings per share from 2014, 2015, 2016, 2017, how will you know if there is growth in earnings per share? Or if earnings per share is falling? Or if there's decline, if there's decline in earnings per share? It's not possible. You have to compute your earnings per share. So please, how do we compute earnings per share? Yes? I'm asking a question. What is the formula for earnings per share? What's the formula for this? Profit after tax minus preference dividends. Preference dividends divided by number of number of outstanding ordinary shares. If you multiply by 100, that means you want to calculate in kobo. So let's calculate, let's see. 2014. Check your question. What is profit after tax? Zainab has, I think maybe half another thing is doing.
No, no. 2014 is 3.6.
You need to attend to something quickly. Others will talk.
3.6.
3.6 million.
Yes, sir.
What is the number of shares? Look at share capital. What do you have there?
5.5.
That is 5.5 million naira.
Yes,
what
sir.
is the nominal value per share?
1 naira.
So how many shares do you have?
Ordinary share media. It's 5.5.
5.5 million shares. Multiply by 100. Compute earnings per share for 2014. Yes. Go to 2015. Profit after tax, 4.1 million. Number of ordinary shares, 5.5 million. Multiply by 100. Please compute for 2015. 2016. Profit after tax, 4.7 million. And Fidelis, I hope you can see it. Number of ordinary shares, 5.5 million. Multiply by 100.
I can see you, sir. I can see your writing.
Now, I'm even referring to your question. We are picking the figure. 2017. Profit after tax, 5.5 million. Number of ordinary shares, 5.5. Multiply by 100. Please, what do you have here?
The first one is 65%.
This is 65 kobo, please.
Oh, sorry, 55 kobo.
If you multiply by 100, that will give you kobo. What do you have here?
75 kobo. 85 kobo.
85 kobo.
Yeah.
100 kobo. Now look at it. Let's also do the growth. Working for. This online is not looking like physical class now. Working for. Growth in earnings per share. Please compare 2015 and 2014. 2015 earnings per share, 75 kobo. 2014, 65 kobo. What is the percentage growth? Please compute. Compare 2016 and 2015. Earnings per share, 85 kobo. Minus 2015, 75 kobo. Divided by 75 kobo. multiply by 100. 2017 and 2016. Earnings per share 2017 100 kobo minus 85 kobo divided by 85 kobo multiplied by 100. Please, what is the growth?
The first
What?
one is 15%.
The first one, 15%.
The second
Second,
one, 13.
13%. Next,
18.
18%. Get the average. The average is equal to 15
Yeah,
plus
15%.
13 plus 18. Divide 3. What do you have, please?
15%.
Let's go to the first sheet. Remember the figures, Abby. I hope you remember the figures. I hope people are copying. Okay, 100, 85, 75,
75.
65.
Yes.
Earnings growth in percentage. This is dash. What do you have here?
Where 15?
15, Abby.
Yes, sir.
15. Next.
13
13.
and 18.
18. Geometric average 15%. Now, the ratio we are calculating, examiner didn't say calculate all these ratios. He only says evaluate company's performance. I can see performance here. This company is growing its revenue. I can see performance here. This company is growing its operating profits. Now, part of the question says, determine if the company is maximizing shareholders' wealth. Determine if this company maximizes shareholders' wealth. Now let me ask the class. What represents wealth to shareholder, please? Hello? What represents wealth to shareholder? Hello? What represents wealth to shareholder? Now, if you purchase a company shares, what represents wealth to you?
Earnings per share.
Your earnings, what other things? If you purchase company shares, what represents wealth to you?
The market value of the shares.
Thank you. Growth in market value. And what? What is wealth? What is income? What represents income to you?
Dividend.
Thank you. I want us to have an interactive class, but I'm not getting that. If you are an investor, you have invested in company shares. What represents wealth to you? You are expecting the company to pay you dividends. That means dividend is part of your wealth. It's paying higher dividend to you. That means your wealth is growing. If the company's market value, if the market value of the company shares is growing, that means your wealth is growing. You must be able to interpret question out to yourself. Examiner says, evaluate performance of a company and determine the extent to which the company has achieved its objective of wealth maximization and continuous growth in earnings per share. I want to know if this company has achieved its objective of continuous growth in earnings per share. Look at it. Is earnings per share not growing from 65 kobo to 75 kobo to 85 kobo to 100 kobo? Is it not growing?
It is growing.
It's growing. You can now base your comment on the fact that yes, this company has achieved its objective of continuous growth in earnings per share. Now talk of wealth. Place yourself as the shareholder. What represents wealth to you? The dividend received is wealth. So if you are getting dividends regularly, that means your wealth is growing. Number two is the growth in your share value. If there's growth in share value, that means the wealth of the shareholders is increasing. Just 1 minute. All right, I just want to take water. Let's continue. We need to calculate earnings per share. Please, how do we compute earnings per share? So we need to calculate dividend per share. Please, how do we compute dividend per share? I remember explaining this and the formula. Dividend per share is equal to your total dividends, that is the gross dividends, the gross dividends divided by number of outstanding ordinary share. Share there. Outstanding ordinary shares. If you want to calculate in kobo, you multiply by 100. You can either calculate in kobo or in naira. Now let's go to this. 2014. What is dividend paid 2014?
3.6 million.
No, 1.6 million. Dividend paid 2014.
Okay, 1.6 million.
Number of ordinary shares, 5.5 million. Multiply by 100. What do you have, please? Dividend paid 2015. Also 1.6 million. Number of ordinary shares, 5.5. Multiply by 100. What do you have, please? Please work that out. 2016. Also look at the figure we are picking. Dividend paid 2015, 1.9 million. Number of ordinary share outstanding, 5.5 million. Multiply by 100. Then 2017. Dividend paid, 2.2 million. Number of ordinary shares, 5.5 million. Multiply by 100. Please, what do you have here?
So the first one is 29.
29 kobo. Please don't forget. What do you have here? Also 29 kobo.
29. 35.
35 kobo.
40 kobo. 40.
40 kobo. Quickly, let's determine percentage growth in dividend per share. Compare 2015 and 2014. Any growth in dividends per share? Any growth? No. Look at it now. 29 kobo, 29 kobo. Any growth?
No.
No. Compare 2016 and 2015. Dividend 2016, 35 kobo minus 29 kobo divided by 29, multiply this.
21%.
21%. Compare 2017 and 2016. Dividend 2017 40 kobo minus 35 kobo divided by 35 kobo multiplied by 100. What is the growth?
14%.
14%. 14%. Then look for the average. Average. This is equal to 0 plus 21 plus, this is not 21, 21 plus 14 divided by 3. Please, you are going to take the 0 also. What is the average, please?
12%.
Approximately 12%. You can put demarcation in case you are looking at the working later. I just pray that the students, you are going to avail yourself this opportunity, because going extra mile to solve it in class. I hope that you avail yourself the opportunity. Now, please remember the figure we have: 29, 29, 35, 40. Then the percentages we have. We are going to sheet 1. In 2017, 40 kobo dividends, 35 kobo,
29.
29 kobo,
29.
kobo. Dividend per growth in percentage. We have nothing here. 0%. 21%,
14.
14%. Then the average. Average, we have
12%.
12%. What you have done is what we call, you have done trend. You have done what? Trend. But in the question, we are giving values for industry average. So I'll term this sheet 1 of your analysis. Sheet 1 of your analysis. We now come to sheet 2. Financial analysis. So, in case you are looking at the working, this is sheet 2. You have your year. (2017), 2016, 2015, 2014. I need to calculate average return on capital employed. So I need to calculate return on capital employed. Return on capital employed. What is the formula? Yes, examiner gave us the formula. Look at the question. Working. Return on capital employed. What is the formula the examiner gave us? The examiner says, I hope we have the question. What's the formula for the question? Please, we are waiting. Oh. Look at the question.
Earning before interest and tax divided by closing total capital employed.
Closing total capital employed. You can now multiply by 100 to get percentage. We now do the work here. We are going to do it here, don't worry. 2017, 2016, 2015, 2014. Earnings before interest and tax. Check. For 2017, 9.8. For 2016, 8.5. For 2017, 7. Then 6.8. Abby?
Yes, sir.
I will now come here, total capital employed. Start with your share capital. What share capital value, please? Share capital, 5.5 million.
5.5. Yes, sir.
5.5, 5.5, 5.5. Then, do we have reserve in the question?
Yes, sir.
Reserve for 2017, how much?
Nil.
No. Reserves.
Okay, it's went down. I think it's from this thing. It's 13.7.
For 2016,
10.4.
For 20,
7.6.
7.6.
6. Yeah.
Then
5.1.
5.1. If you add this together, you are going to get shareholders' funds. Share capital plus reserves will give you what we call shareholders funds. Is that clear, please?
Yes, sir.
That's your shareholders funds. Money belonging to the shareholder. Please sum up.
19.2.
19.2.
15.9.
15.9. This is 6, Abby.
13.1.
13.1.
10.6.
0.6. You can now add your debt. Your debt is your bond. What is the bond value, please?
20.
20 million, 20 million, 20 million, 20 million. You can now get total capital employed. Total capital employed is shareholders' funds plus long-term debt. Are we there, please? Total
Yes,
capital employed is shareholders' funds plus long-term debt. Your long-term debt is your bond. You can add now.
39.2.
39.2.
35.9.
35.9.
33.1.
33.1.
30.6.
30.6. We can now compute return. We can compute our rows now. Is that not? Look
Yes,
at the
sir.
formula now.
Yeah.
CP divided by total capital employed. 9.8 divided by 39.2 multiplied by 100. What do you have, please?
25%. 25%.
25%. 2016, 8.5 divided by 35.9 multiplied by 100. What do you have?
24%.
2015, 7.5 divided by 33.1. What do you have?
23%.
Then it should give you, check out, 22%. Now let me quickly say that for this, if you are comparing with industry standard, you don't calculate geometric average. You have been given the average. Hello?
Yes, sir.
If you are comparing with industry standard, that industry standard represents the average. So you don't compute geometric average again.
Okay.
You can now pick your figure. Come here. %, 24%,
23.
23%, 22%. Next, look at the second you are giving. You have done, you are giving average return on capital employed. What next? Check the question. Amaka, what next to be completed? Is Wilson online?
So I did the growth rate.
We don't calculate growth here. Now look at the average you are giving. Go to the question, please. You are giving 5 averages.
Yeah.
Look at it. We have done return on capital employed. What next?
Shareholders fund.
Return on shareholders funds. Is that not?
Yes, sir.
You are giving for the industry. Then you need to compute for your company. Your company is Choice Aluminum. Is that clear, please? You now come here. Return on equity. Also, please also note, it's also called return on equity. This was the question last diet. Question number 7. We shall get there by God's grace. What is the formula for return on shareholders' funds? What's the formula? I know I gave this formula last week. I can use here now. I can manage here. Please, what's the formula? Return on shareholders' funds. Return on equity. So also return on shareholders' funds. We always call it return on shareholders' funds. What's the formula, please? It's calculated as profit after tax divided by shareholders funds. Please, let me say this. Like I told them in the physical class, sincerely, last diet, 2 questions was picked on here. I was wondering. We now study the trend. You are going to have more of this coming now. Financial analysis is a key component that guides investors' decision. And what the examiner will be asking you is more of technical analysis. Last diet question was very simple, but it requires you to have a considerable knowledge of technical analysis. Check question number 7. Check question number 4, last diet. Please, all these formula and their interpretation is very important to us. God will give us a better understanding,
Amen.
You now come here. You have the formula now. 2017, we'll manage the space. 2016, let's do this first. Profit after tax, 2017, how much, please? Check the question.
2017, 5.5.
5.5 million. 2016, how much?
4.7.
4.7. I can manage it for 2015 now. 2015, how much?
4.1.
I can now come here. Shareholders fund, XF. Look at shareholders funds. Pick your figure. 19.2. Pick your figure.
15.9.
15.9.
13.1.
13.1. Please calculate return on equity. 5.5 divided by 19.2 multiplied by 100. What do you have, please?
29%.
Come here. 4.7 divided by 15.9 multiplied by 100. What do you have?
30.
30%. Check out. 4.1 divided by 13.1 multiplied by 100.
31%.
Then we can do for 2014 as an exception. 2014, my profit after tax,
3.6.
3.6 divided by
10.6.
10.6 multiplied by 100 over 1. What do you have, please?
34%.
34%. Please, you don't calculate average here because we are going to compare with industry standard.
Okay.
I can come here now. %29%, 30%, 34%, 31, Abi?
Yes, at 31.
31%,
34.
34%. What is next? Look at that value for the business sector.
So we have interest coverage.
I will now come here. We are giving the average interest cover ratio. Then let me calculate interest cover ratio for Choice Aluminum. Interest coverage. Please, what is the formula for interest cover ratio? Amaka, what's the formula for interest cover ratio? Okay, Fidelis. What's the formula? Whose iPhone self? Believe, what's the formula for interest cover ratio? That will give you your earnings before interest and tax divided by the interest expense. Your interest cover ratio, please notice, is the number of times operating profit covers interest expense. Please notice, your interest cover ratio is the number of times the operating profit covers interest expense. The formula is earnings before interest and tax divided by the interest expense. We can, with this formula, we can compute 2017, 2016, 2015, 2014. Yeah, please check. What is the earnings before interest and tax? 2017.
9.8.
9.8 million. Next,
8.5.
8.5. Next,
7.5.
7.5 million. Next,
6.8.
6.8 million. Interest expense. The interest. Interest is calculated on debt. What is the percentage of bond?
8%.
Now, please compute 8% of 20 million. What is the interest?
$1.6.
1.6 million. 1.6 million. 0.6 million. 1.6 million. Now calculate interest cover ratio. It's calculated in time, so interest cover ratio. Please divide 9.8 divided by 1.6.
6 times.
What do you have?
6.
6.1.
6.1. Yeah.
Do same for 20. Do same for the other years.
5.3. The next one.
5.3. Next.
4.7.
4.7. Next.
4.3.
Please note, it puts in brackets, is calculated in times. Times. So please don't multiply by 100. Though.
Okay.
You have calculated your interest cover ratio. Number of times operating profit covers interest payment. I can come here 6.1 times 5.3, 4.7, then
4.3.
4.3. You are giving the industry average. The industry average is 20 times, Sabi,
Yes, sir.
and you have computed 6.1 is below industry average.
Mhm.
That means financial risk is very high. Calculated in times. The number of times the company's operating profit covers the interest payments. The higher the ratio, the better for the company. Look at the case now. This company ratio is low. An indication that the company cannot meet its interest payments in line with the industry standard. What next?
Debt to equity ratio.
Examiner says, let me explain this. You can compute debt to equity ratio using market value or book value. You can compute debt to equity ratio. Look at it. Debt to equity. Market value. Please, always calculate debt to equity ratio using market value approach, unless the examiner states otherwise. Hello?
Yes, sir.
Please always compute your debt to equity ratio using market value approach, unless the examiner states otherwise. In this question, we are told to use market value approach. We can do it here. Working debt slash equity ratio. Market value basis. You are going to get market value of debt divided by the market value of equity. Look at the formula for this. The formula is market value of debt divided by market value of equity. Then you can now multiply by 100. So you come here, you have your year, 2017, 2016, 2015, then 2014. I will start with market value of debt. Naira sign in million. naira sign in million, naira sign in million, naira sign in million. Now look at the notes. After the financial information you are given, examiner says the bond of Choice Aluminum. Can we all see it, please? Can we see it? Can we all see it?
Not yet, sir.
You have to check. You know, we are advised to try and print the question. Or if you have,
Okay, we
if
can
you
see it.
have work study pack, is there. Are you in the question now?
Yes, sir.
Now look at, after the financial information, look at the next notes. The par value of the share of CA is 1 naira per share. General level of inflation has averaged 4%. Now next, the bond of Choice Aluminum are currently value of 100 naira. Where the examiner says a bond, that is a debt. The bond are trading at their par value. It means that the market value of the debt is the same as the nominal value of the debt. If the question says a bond is trading at the par value, that is the trading price at the market, is at the par value, it means that the nominal value of the bond is the same as the market value. Nominal value of this bond is 20 million. Look at the financial information. How much?
20 million.
It also means that the market value, because it's trading at par, it means that the market value is also 20 million. Market value of the debt is also 20 million. Because it is trading at par value, and the par value is 100 naira. We have done bond valuation in this class, and we explained this. A bond can be trading at par value, or at a premium, or at a discount. If your bond is trading at par value, it means that the nominal value of the bond is also the same as the market value. When we say nominal value, the nominal value is your balance sheet value. Any amount of the financial position is the nominal value. Your statement of financial position is prepared using the nominal value, or what we call the book value. Is that clear, please? Is that clear?
Yes, sir.
But if it is not trading at nominal value, that means value will change. You. Excuse me. Then we need to get market value of the share of equity. Market value of equity. Market value of equity is equal to number of ordinary shares multiplied by the market price per share. Please write it down. Please write it down. Let me take water, please. I said the market value of an equity is equal to the number of ordinary shares multiplied by the market price per share. Just 1 minute. Let's continue. Let me manage here for that. (2017). How many shares do we have? 5.5 million shares, Abby.
Yes, sir.
Now check 2017. What is the share price? Look at the financial information. What is the share price?
It's 5.5.
No. Look at the financial information. Look at the last information.
Okay, 8 kobo, 8 naira 64 kobo.
8 naira 64 kobo.
Yes, sir.
Multiplied by number of ordinary shares. Please multiply.
Okay.
8 naira 64 kobo. Check for 2017. What do you have?
So it's the 47.5.
47.5 million. You are correct now. Go to 2016.
Okay.
You have 5.5 million shares. What is the share price? 2020.
5 naira 74 kobo.
Come here. 5 naira 74. Please multiply. What do you have?
31.6.
31.6. Go to 2015. You have 5.5 shares. What is the share price?
3 naira 35 kobo.
35 kobo. Let's multiply.
18.4.
18.4 million. And go to 2014. Number of shares, 5.5 million. What is the price per share?
2 naira 67 kobo.
7 kobo. Please multiply.
14.7.
14.7 million. You can now calculate your debt to equity ratio. Meaning 20 million divided by 47.5 million multiplied by 100.
42%. 42%.
42%. Next, 20 million divided by 31.6. 31.6.
63%.
63%. Next, 20 divided by 18.4.
108. Oh, sorry, 109.
approximately.
Yeah.
Next, 20 divided by 14.7.
One 136.
You have gotten, you can save this. Now, this is full. Note your figure. 42, 63, 109, 136. You can come here now. 42%,
63%.
63%,
109.
109,
136.
136. Then what is the last one you have there?
Please, I have a question.
I'm not sure you have the question printed. You have to go and check, Abby.
So I
No,
have a
the-
question.
Somebody is trying to speak.
Yes, sir. I think I have a question, please.
Yes, your question.
Yes, sir. In the same paragraph, right, I saw something like general inflation rates. Is
Yes.
that being considered when calculating the share price?
Okay. If you look at that, examiner says inflation rate has averaged 4%, Abby,
Yes, sir.
for the period under consideration. That means every year for 4%, Abby, there
Yes,
is
sir.
no change in inflation. You will not consider it.
Okay. So why? Sorry.
The inflation rate is the same now for 4% every year, Abby.
Yes, sir.
What that statement is telling that inflation remains unchanged. But if the inflation in 2014 is different from inflation in 2015, is different from 2016, then you are going to now consider it.
All right, sir. Thank you.
That statement is a distraction. For this particular question, that statement is a distraction. Is that better?
All right, sir. Yes, sir.
So, sir, if you are to consider it, how are you going to calculate it? How is it going to be applicable?
Examiner will now, if examiner says inflation for year 1 is different from year 2, that means you are going to have real cash flow and
Okay.
nominal cash flow. Examiner will now ask you what to do with that inflation.
Okay.
Examiner must tell you what to do. Like a question a student referred to me. Examiner gave that inflation. I say calculate real dividend per share. Calculate nominal dividend per share. Nominal dividend per share is inflation. Real dividend per share is dividend per share without inflation.
Okay.
Is that better, please?
Yes, sir. Thank you. So, sir, this equity to debt to equity ratio, the average percentage given is 50%. in the question given by the examiner is 50%.
That is the average for the industry, Abi.
Yes. So
Okay.
what's the interpretation of the one we just calculated now compared to what is given for the industry?
Okay. If you have to ask now, if I'm to ask you, in 2014, this company has debt equity ratio 136%, and the industry average is 50. What will be your comments? What will be your comments?
The debt is really high.
This company is too GH.
Yeah.
This company has excessive debt. Abi?
Yes, sir.
What about 109?
It's still high.
In line with industry standard, Abi? What about 136?
That is 63 is still high. It's highly
Is it-
geared.
What about 42?
It's below.
Thank you. That means the company financial gearing is reducing, Abi,
Yes, sir. Okay.
until it's now within the industry average. In 2017, the company debt to equity ratio is within the industry average.
Okay.
But the comment is still coming later.
Okay, sir.
Now let's look at the last computation. Look at the average you are giving. Can you see it?
Yes, sir.
Return predicted by the capital asset pricing model. How much?
14%.
That means model. Let me explain it briefly. That's based on the level of risk in this industry. Based on the level of risk in this industry, an investor should be able to get 14% return. That is the return predicted by the capital asset pricing model. CAPM model return is based on risk. Based on the risk in the industry, an investor should be able to get 14% return. We now come here and calculate returns to the shareholders of Choice Aluminum. In calculating return, you are going to look at total shareholders excuse me, return. Now, like I asked, what represents return to shareholders? Is your dividend and what?
Earnings per share.
Earnings per share is not your return.
Market price of the share.
Growth in your share price. Earnings per share is not returned to you. What is returned to you is dividend paid to you. Earnings per share is not a return to you. Out of that earnings per share, company will now pay dividend per share. You are not going to have difference between earnings per share and dividend per share is what we call retained earnings per share. Hello? Your earnings per share is not returned. It only shows the earnings available for shareholders. Out of that earnings, company will now pay dividends. out of the earnings per share, company now pay dividend per share. The difference between earnings per share and dividend per share is what we call retained earnings per share. You must interpret that to yourself. What represents returns to shareholders are two things. One, your dividends received and growth in the share price. You know, you can dispose, if the share value is growing, you can dispose your shares and generate money. Please note, there are two things that represent return to shareholders. One is the dividends received and the growth in share value. Your growth in share value is what we call capital gain or capital appreciation. Let's compute this and round up. Total shareholders return, TSR, is calculated as capital gain plus dividend per share divided by opening share price multiplied by 100. Your capital gain, is equal to closing share price minus opening share we can now go to this working. Please look at it. I have 2017, 2016, 2015, 2014. The share price you are giving, your share price for what is share price here?
8.64 kobo.
You can convert everything to kobo.
Okay.
Because the dividend is in kobo.
Okay.
Look at it. Our dividend is calculated in kobo here.
Okay.
You can also take that share price to kobo. Are we here? That means we are here now.
Yes, sir.
I can come here. If I take this to kobo, it become 800 and 64 kobo. Is that not?
Yes, sir.
Become
7 4
574 kobo. 3
3 5
35 kobo. 2 67 kobo. Now compare. In 2014, share price was 267 kobo. In 2015, share price 335 kobo. Is there a growth in share value?
Yes, sir.
What is the growth difference?
68
Tell us
kobo.
the difference.
68 kobo.
That is what we call capital gain. Capital gain. I have 68 kobo here. Check 2015 to 2016. Growth in share value. Any?
Yes, sir.
Please
239.
compute. Two what?
239.
239 kobo. Check 2016 to 2017. Any growth in share value?
290.
290 kobo. You have gotten your capital gain. You cannot get for 2014, but you have gotten for 2015, 2016, 2017. I can come here now. In 2015, I want to compute total shareholders return. This is equal to capital gain, how much? For 2015, 68
kobo.
Plus, what is dividend in 2015? Let's go to page 1. We have to go there. What is the dividend in 2015?
29 kobo.
29. Move back. Page 9. Dividend per share. 29 kobo. Divided by opening share price. Look at this. When we say opening share price for 2015 is going to be 2014 figure. Look at this figure. 267 kobo. That was the closing share price in 2014. It was closing for 2014. It becomes what? Opening for what?
For 2015.
That is your opening share price 2015. You now come here. Opening share price 2015. That was the closing share price in 2014. It becomes opening in 2015. 265 kobo. Now multiply by 100. That will give you total shareholders return in 2015. Please work that out.
36%.
That will give you 36%. I just want to put a demarcation. 2016. Total shareholders return. This is equal to capital gain 2016. How much? How much?
239.
239. Dividends 2016.
35 kobo.
35 kobo. Opening share price 2016. Look at this figure. That was the closing share price in 2015. It becomes opening in 2016. Is that clear, please?
Yes, sir.
Three, 5 multiplied by 100. Get your figure out.
82%.
82%. I can close this one again. (2017) total shareholders return. Capital gain, how much?
290.
290. Dividend per share 2017.
40.
40 kobo. Divided by opening share price. 2016, it was closing 574 kobo. And it becomes opening for 2017. Come here, 574 kobo multiplied by 100. What is the total shareholders return?
57%.
You can observe this now. What is the return predicted by CAPEN?
14%.
That means this company is generating, is giving its shareholder higher return than what is predicted by the industry. It also means that this company is doing well because it's able to meet the expectation of the shareholders. Is it maximizing the wealth of the shareholders? Yes.
Yes.
From what we have computed, I can come here now. Total shareholders return. (57%), 82%, 36%. I can't compute for this year. You are done with all the analysis. What remains is your comment now. You are done with all your analysis. What remains now is your comments. Any question with the analysis? Any question, please? Okay. Let's share the comments. Look at your comments. Achievement of corporate objective. Choice Aluminium has shareholders' wealth maximization as an objective. The wealth of shareholder is increased by dividends received and capital gain on share owned. Total shareholders return compares sum of dividends received plus the capital gain with opening share price. The shareholders of had a return of, okay, maybe it was approximately a return of 57% in 2017. That was what we computed. compared with return predicted by CAPM, 14%. The lowest return which shareholder has received is 36%, and the highest was 82%. On this basis, the shareholders of the company has experienced a significant increase in wealth. It is debatable whether this has been as a result of the actions of the company. Share prices may increase irrespective of the actions of the company's manager. You have commented on that. Look at the second paragraph. Another objective of the company, excuse me, please. Another objective of the company was to achieve a continuous increase in earnings per share. Analysis shows that earnings per share increase every year by an average of 15%. We computed this. Check financial analysis 1. This objective appears to have been achieved. We have responded to this aspect now. We have responded to these two. Wealth maximization and continuous growth in earnings per share. Next, evaluate financial performance. Look at this, please. Return on capital employed has been growing towards the sector average of 25% on a year-by-year basis. Look at what we are referring to. Please look at what we are referring to. Let's look at it. Return on capital employed has been growing from 22 to 13 to 23 to 24 to 25. Look at the comments. Return on capital employed has been growing towards the sector average of 25% on a year-by-year basis from 22% in 2014. This steady growth in the primary accounting ratio can be contrasted with irregular growth in turnover. Look at the turnover. Look at turnover. %, 26%, then it dropped to 17%. This is irregular growth. Next comments. Return on shareholders' funds. Return on shareholders' funds has been consistently higher than the industry. Look at the industry average. Look at the average. Average is 20%. Then let's look at our company's own. We have 29, 30, 31, 34. Even though it's falling, 34, 31, 30, 29. This is still above the industry average, which implies that this company is generating sufficient return on shareholders' funds. Return on shareholders' fund has been consistently higher than the average for the sector. This may be due more to the capital structure of the company. This may be as a result of the company's capital structure than to good performance. It might not be as a result of good performance. The company capital structure comment number 3 and 4, financial risk ratio. Except for 2017, the company's gearing ratio was higher than the sector average. Is that not, please?
Yes, sir.
The company debt to equity ratio is higher than the industry average. Look at this. We now come here. More comments. The current debt to equity ratio is, no, this should be continuation now. It should be continuation of this. The current debt to equity ratio of the company is 42%. Although this is less than the sector average. Although this is less than the sector average value of 50%. It is more useful from a financial risk perspective to look at the extent to which interest payments are covered by the profits. It is more useful from a financial risk perspective to look at the interest coverage ratio, because we must pay interest. Are we making enough profits to be able to pay interest? Look at the interest cover ratio as computed, 6.1 times 5.3 times 4.7, 4.3. Look at the comments. The interest coverage ratio is not only below the sector average. Sector average is 20 times. It is also low. It is also low enough to be a cause for concern. Why the ratio show an upward trend over the period under consideration? It still indicates that an issue of debt will not be wise. What that statement is trying to say is the company is trying to raise new finance, and the interest cover ratio is not favorable. Look at it, please. Look at the starting point. Choice Aluminum is planning to raise 130 million to finance expansion, and is considering rights issue, placing, or issue of bond. With this interest cover ratio, will it be wise for the company to issue new bond? The answer is no. With this interest cover ratio, it is not wise for the company to introduce bond now. Why is he even jumping now? Okay. A placing or equity, such as right issue or public offer, will reduce the journey. That is, that 130 million is not wise for the company to raise it using bond issue. The company should consider placing or any issue of new shares, such as rights or public offer, will reduce journey. If the expansion of the business result in increase in profit before interest and tax, the interest cover ratio will increase. Financial risk will fall. Given the current financial position of the company, a decrease in financial risk is certainly preferable. With this analysis, we can advise the company to use debt. It's better to raise the 130 million using equity finance. Then the B part, we have to explain. Let's round up the question. We have just 5 minutes, it's fine. Look at requirement B. Analyze and discuss the relative merits of a right issue, a placing, or an issue of bond as a way of raising finance for expansion. What is the advantage of right issue or placing? That is the merits, or bond issue. What is the relative advantage? A placing will dilute ownership and control. That's a disadvantage. Provided new equity issue is taken over by new institutional investors. A right issue will not dilute ownership and control. That's a merit. Relative to placing, placing can cause dilution in ownership and control, but right issue will not cause dilution in ownership and control, provided the existing shareholders take up their rights. A bond issue does not have ownership and control implication. Although restrictive covenants in bond issue documents, negative covenants, restrictive covenants in the bond issue documents can limit the action of a company or its manager. When we say negative covenants, bond finance or debt finance comes with conditions. Some of these conditions are not favorable. In most cases, these conditions can limit the activities of the company and its manager. All the three finance choices are long-term sources of finance, and so are appropriate for a long-term investment, such as the proposed expansion. Equity issue, such as placing or right issue, do not require security. If you are issuing new shares, you don't require collateral. But if you are talking of bond issue, the lender may demand collateral. So at any point in time, the company is considering issuing new bond. Company must consider whether it has sufficient non-current asset to serve as collateral. You are done with the question fully. Any question, please?